Hi everyone. I wanted to repost this video. Somehow the previous video that I made about this spreadsheet, I must have deleted it somehow in my Google Drive. Many people reached out to me over Twitter in DMs asking me to repost this or that the spreadsheet wasn't linked anymore. So I'm going to be doing a small tutorial on how to use my spreadsheet and just the way I trade with position sizing, etc. Everything that I'm showing you in this spreadsheet, in the risk rules, the selling rules, the position sizing, everything I got 100% from Mark Minervini's book. So think and trade like a champion and trade like a stock market wizard. I don't have the pages offhand, but everything here that you're going to see in this video, none of this is mine. It's all taken from Mark's books and Mark's methodology. I've just put it into a spreadsheet to help me visualize it and manage it. So this is my spreadsheet. So my spreadsheet has some. I'll go over the various components of this spreadsheet that I use to manage my day-to-day trading. So first of all, you put in your account size. So I'm going to use $10,000 as an example, and that's configured here. So for example, if you have an account size of $4,300, you just type that in, and it's right here. I'm going to delete this because that's for later. So I'm going to put it back to $10,000 because $10,000 is a nice round number, and we'll start. So using Mark's methodology and a lot of the research that he has done, the optimal risk size or maximum risk size per trade is 1.25% of total account size. So that means if you have a $10,000 account, you cannot risk more than $125 on any individual trade. So that is, trading everything risk first. So some of the shortcuts that I have here are half position. Full position is $2,500. A full position being 25% of your account. A half position, $1,250, or half of 2,500, and a quarter position, $625. So this is basically Mark's guidelines. Mark has said that your maximum position size of 25%, and this is using optimal F, the Kelly formula, a lot of statisticians and a lot of math, and that's where they have deemed the optimal position size and risk. So how do you use this? So let's say we're looking at a name like CLPT. Now I'm not talking about breakouts or setups or whatever. We're just playing straight math right here. Let's just say that you're doing your research and you want to buy CLPT. And you want to buy it if it passes the high of this Friday value. So we're saying that, it crosses and goes above that point. So your pivot buy point is here. Okay? Or the high of that day, which is 1240. So you would come to the spreadsheet and you would write CLPT. And you would write 1240 because that's the price you want to buy the stock. So a couple things are going on here now. I have some shortcuts. So for example, in Mark's methodology, he always says that you never want to pay up for a stock, meaning you want to buy it at the right price, the right pivot price, and no more. And if his tolerance is no more than 1 or 2%. So that means don't buy gap ups, don't buy it late. If it took off without you, let it go. So if I were to buy this stock at 1240, my maximum price, or I would determine that 1240 is the price I want to buy this stock for. The maximum price I should pay for is 1252 or 1265. So that allows me to put, let's say, a buy stop limit order. I could put stop $12.40, limit $12.52, and I guarantee that if it hits my price or it breaks out, I don't overpay for it. And if it gaps up, I don't buy it. So those are some shortcuts. Then we also have just some quick shortcuts that says what is a 1% stop, 2% stop, 3% stop, 5%, and 7%. So that's just some shortcut math that you can use if you want to quickly say, hey, I'm going to buy this with it. What's a 3% stop, etc. And I'll show you that in a moment. As well, you could use a combination of staggered stops. So for example, if you bought 90 shares of this CLPT and you put 30 at a 3% stop, 30 at a 5% stop, and 30 shares at a 7% stop, if you got stopped out of everything, you would only have been stopped out for 5%, right? Because 3, 5, 7. Read in Mark's books about how staggered stops work, but what that allows you to do is that if the stock goes down, let's say 3%, you sell off a piece of it, and then you sell off a piece of it. But if it turns around and goes back up, you're still holding some, which is a big benefit. Okay, so now we're going to use the position calculator. So the way the position calculator works, it says, okay, CLPT, $12.40 is the price I want to buy it for. So then I open up my position size dropdown, and I can select from various values. So let's say I want to see 6.25%, quarter position. That's 50 shares. If I wanted to buy a half position, that's 101 shares. And if I wanted to buy a full position, that's 202 shares. And if you look here, full position, $2,500, there's just a little bit of rounding, close enough. So now let's say that we go to the chart and we say, okay, where's a logical place that I want to put my stop? And let's just say that, for argument's sake, I want to put my stop at the low of this day. So the low of this day right here, the 18th. And the low of that day is 11.56. So let's say I'll just put it a couple pennies below and I'll say, okay, I bought 202 shares and 11.50 stop. So if I look at this and I say, okay, 202 shares, full position, 11.50 stop, this is 7.26% stop. Now, I don't really care about the individual risk on an individual stock. I care about my total risk to equity. So if I look here, my total risk to my account size is a 1.82, which is much more than 1.25. Because remember, my max stop dollars for a $10,000 account needs to be no more than $125, and here it's $180. So that means I am putting on more risk than I should as per optimal trading rules. So there's a few things I can do here. One, I could buy less shares. So let's say 20%. With the same stop, I'm going to buy 161 shares. I'm still high, right? So I'm still at 145. That's too high. I can buy, again, less shares. Let's say I buy 15%, so 121. Now I'm well below the 1.25 maximum, and my total risk for this trade is $108.90. Still maintaining the same 7%. That's the support I've determined as that. Now, another way to do this is to say, okay, well, no, I want to buy a quarter position. Excuse me. But I can just have a tighter stop. Now, see, I have $181 risk. That's way too much. So let's go back to my trade, and let's say that I'm going to say, okay, I'm going to buy it at this stock, but I'm going to use the low of the day, which is 1180. So I'll go back to my spreadsheet and say, okay, 1180. What does that do? Do you see now, tightening my stop a little bit, I went from 7 to under 5%. And now I'm well in my acceptable parameters because my maximum loss is $125. So I can either reduce the amount of shares that I want to buy to get it into the right tolerance of risk, or I can tighten my stops. And we'll just add another stock, and we'll just call it whatever, ABC stock at $16.50. Okay, Some reason the formula is missing here. Okay, and then we'll say I'm going to buy another quarter, a full position of this stock, 152 with a, we're just going to say 3% stop, 1601. So you notice here, 3% stop, I've just put in. So this is well within my parameters. This is something that I'm buying on speculation, whatever. What I wanted to show you here is that we have a value here called percentage invested. You'll notice that I'm 50% invested because I have a $10,000 account and I have $5,000 worth of shares purchased. So if I were to tweak this and say, okay, 75, for example, I'm 37% invested. So for my account, so, you know, if you're doing well, you'll get more invested. If you're not doing well or the market conditions are poor, you'll be less percent of your account invested. Again, so I'm going to put, now I'm just going to do another one, ABC, XYZ stock, and we'll say here $17 just for an example, and I bought a full position. I bought 147 shares, and I put a 5% stop. And I'm just using these little shortcuts here. So you'll notice that this is perfect 1.25. That's my maximum stop loss. You'll notice that I'm 75% invested now. Now this is this is what Mark calls the pillow factor. So you see here that if all of my stocks go to hell and hit my stops, I would lose 3.21% or $320.63. Now, maybe that doesn't work for me. Maybe that's too much risk for me. Maybe I can't afford to lose that much. Whatever your number is and whatever your comfort zone is what you, so you want to back into that risk. So let's just say, for argument's sake, I don't want to lose at any time more than 2% of total equity. So what could I do? I have these three positions on. I could start tightening my stops somewhat. So for example, this is a 5% stop. What if I went to 1649? I raised my stop a little bit to 3%. I'm just using these little shortcuts. Now you notice how my risk has dropped down from 3 plus to 2.7. Well, let's say here I want to tighten this up a little bit. So rather than a 4% stop, I'm also going to go to a 3% stop. Notice again, 2.24. You get the idea. So you can play with raising your stops, selling a piece off, etc. And that's how you manage risk. So another thing that I have in the spreadsheet, and I'm going to just erase this. Is a progressive exposure indicator. So what does that mean? So let's just say we bought CLPT, okay, and we bought it with the original stop of, call it, we'll just put 1153, just a 7% stop. Okay, that's a little bit much. So we're going to go with a 5% stop. Right, so we're just under here. Okay, so my total trade risk is $125.24. So let's just say I'm a 2-to-1. I want to sell for a minimum of multiples of my risk. And let's just say I want to sell for a 2R. So meaning that I risk $125. I want to sell it for no less than $250. Perfect. So let's say that happened. Obviously, I'm coming in. Let's say I'm coming in from cash. I have a very small position on. That's all risk. But if I'm lucky enough that trade works, then I would go into my portfolio, and I would go into my portfolio page, and where it says indicator, I'll put CLPT. Let's say I made $250 on that trade. So you see now it says progressive exposure with a small typo. If I go back to the main page, you see how it says here $250. Now so what I do is I start adding up my gains and my losses. So let's just say I bought a stock, ABC stock, and I got stopped out for $75. Well, my total exposure now is 175. So that means like I could buy, let's say I want to buy two new stocks. I want to buy ABC and XYZ. Okay, and let's just say this is $16 and this is $17.50 for argument's sake. Okay, and I'm going to buy quarter positions, 143, and I'll just put a 5% stop at each one and see what that does. Okay, so I have total exposure of $175. And if I look here, my total risk here is 199.16. So it's more than what I've gained off my last trade. So if I want to use progressive exposure, I want to have my last trades finance my current trade. So what I'll do is maybe I'll tweak this a little bit, and maybe instead of 5%, I'll go with a 3% stop here. Just to give an example. So you see here now, I'm risking just under $150. So what's happened is now I had one stock that made me $250 or $175, excuse me. And now I'm taking two shares from my gains, and I'm using that money to finance my risk. Okay, so see, because I had a win and a loss, right? I had a win on CLPT and I lost $75 on ABC, so I'm ahead $175. But my next two trades are only risking $150. So that way I'm using progressive exposure to finance risk for my trades going forward. Okay. Something else I've added to this spreadsheet is a focus list using Excel's feature on spreadsheets, on stock lists. So what I have here is, for example, I have here, I downloaded from Market Search the new RS high line. So if I take these names, I'm just going to copy these names. And if I were to just paste those names into here and then click stocks in the data tab of Excel, what Excel does is it looks up all of those names, gets me the last price, and then I use my formulas for my position sizing. So if I'm interested in getting into Carvana based on my $10,000 position size, based on the last price posted to the market, I know that I could, quarter position is 4 stocks, half position is 7, 15% 9, etc., etc. And I can do that for all of these names. So this is just a quick down and dirty calculation. You can just throw some names in there, and based on your account size, you can immediately know at hand, ballpark, hey, what's 25% position size for me on this name? What's a 15% position size, etc., etc. And to do that again, I just grab the names, I delete them, I'll go back to my spreadsheet, and let's just say I'm looking at these number of names. I just go copy, I go back to my spreadsheet, I paste it, I tell it this data is stocks, and it'll quickly get the symbol, the full name of the company, and put the formulas. And if you wanted to add more stuff, there's like a little drop-down list where you can add a whole bunch of stuff like market cap, official name, the headquarters, the high, the lows, etc. I don't use any of that, but it's all in there, and it's free from Excel. Google Sheets has the exact same thing. It's just slightly different. It just uses a Google tag, but it's basically the exact same functionality, and you can do the same thing in Google Sheets. The last thing that I added to this spreadsheet is a risk reduced calculator, meaning, so you come in here and you type in your symbol, Meta, and then Meta will calculate the last price. So for example, let's go to Meta. Let's say I wanted to buy Meta on this day with the high of the day before. So the high of the day before was 527.58. So we're saying that I bought Meta here at 527.58. So I go to my spreadsheet and I put in the price. Sorry, I think I got the wrong number here. Yeah, 527.58. Okay. So I write the price that I bought it for, 527.58. Let's say I bought 100 shares. And let's say my stop for Meta was here at the low of the day, which is 495.60. 495.60. So a 6% stop. How did we get to that? Right? We're going to say that I'm buying it here, and there's my 6% stop, approximately, right? So obviously it's just because of the magnification, but it's about a 6% stop. So now I look at my spreadsheet and I say, okay, well, I bought it at 527, but now it's gone up some. It's at 563, right? So if I bought it here at this price, at 563, well, look where it's gone up to, right? It's gone up 6% or 5.8%, etc. So what can I do now? If I want to mitigate my risk, this spreadsheet is telling me that if I sell 49 shares, I would be at break even or selling half. But let's say the price is a little bit lower, right? Let's say my stop was tighter. So for example, let's say I didn't use the low of this day. Let's say I bought the stock here, breaking out of this point, but I used the low of the day as my stop. So let's just say the low of the day is 517.11. So I go to my stop and I put 517.11. So with a tighter stop, only 2% risk, and if the current price was $561.35, I would need to only sell 24 shares of the 100, and now I'm at no risk. If the stock comes back and hits my stop, I've lost zero. I can leave my stop where it is, and if it goes up, I'm essentially playing this trade risk-free. This was a spreadsheet given to me by a good friend of mine, and I use it often. So I hope you guys find this helpful. I'm going to try to be a little bit more vocal on Twitter, sharing some ideas, and just for my own benefit, and hopefully other people can benefit as well. And I hope that you found this stuff useful.